In our last video, we went through a thorough breakdown of the closing costs, and we talked through definitions of what these costs are and give an average on what you could expect to pay. In today's video, we're going to get a more detailed look at how to identify these costs, where you'll see these listed on the disclosures and basically how you can shop from one lender to the next and have a better understanding of what you're paying for. So we're going to talk about two different forms today, although in this video, I'm going to show you just one of those two forms. We're going to be looking at a closing disclosure, which you'll hear called the CD. When you're looking at your closing cost, your lender is going to send you a form, a loan estimate, an LE. So the loan estimate is going to give you a breakdown of all those costs. As you go through the transaction, some of those costs will change because some costs are not available at the time of the loan estimate. For example, title charges. In most states, the title charges are determined by the seller side. Well, when you're looking at an initial transaction, you may not have a property identified. So lenders will use an estimate for these title charges. Other factors like homeowner's insurance. This is another line item that you'll see an estimate until you have the actual finalized number. In today's video, we'll look at a closing disclosure, which will show a more finalized version of what the loan estimate is. Now, other than a few differences in these numbers, though, I can tell you that these forms look almost identical. So as we go through and we look at the closing disclosure, this will give you a better understanding of how to understand a loan estimate and what to look for. So let's just dive right in. And the best part about today's video is that you don't have to spend the whole time just looking at me. We can go through and we'll show you this closing disclosure and walk through that. If you like this information, you're looking for more education on buying a home and real estate transactions, remember to like and subscribe so we can continue to share this with you. All right, so jumping right in, you'll see at the top, we have the basic information about the transaction. This is where you're going to find your personal information, and this is everything from who you are, where you live. We'll also see the information listed from the seller, so you're going to see who the seller of the property is. Now in this version, this is all blanked out so that you can't identify who this exact CD was for, but these are the areas where you'll find that information. You'll find your lender's information. You'll also see the date that this document was issued, which is important because when you're comparing lenders, you want to make sure that you're comparing the interest rate and the costs at the same time. Rates change every day throughout the day. You don't want to find yourself in a position where you're looking at a lender that actually may be more beneficial, maybe you're comfortable working with them, but then you compare this to another lender 5 days later, not knowing that the interest rates got better, not that lender is actually giving you a better deal. So you always want to make sure that you get it in writing and compare and do this on the same day or as at least as close as possible. So you'll see that. You're going to also see listed the closing date. This is the date where you can look to have your settlement. You'll go to an escrow company and sign the documentation. You also see the disbursement date, and this will be the day that you can expect those funds to be provided to the seller so that you'll be able to take possession of the property. And then below that is the settlement agent, which is the title company or the escrow company that you'll be going to, and the property address. Now, getting into some of the more details, some of the things I like to point out on this, you'll see the sales price of the property. This is very important. You want to see and make sure that this matches up with the estimate that you're expecting to see. Over on the far right side of this top bar, you're going to see the loan information. This tells you, in this case, a 30-year fixed for a purchase. You'll see the type of financing, conventional, FHA, VA. It's important to make sure the correct box is checked on this. Going through and looking at this, then one of the main differences you'll see with a loan estimate and a closing disclosure is that in this section, you'll be able to see if that interest rate has been locked or not. So pay close attention to that because if you're working with a lender and they tell you the interest rate is locked, they send you a loan estimate and that box is not checked, well, there could be a problem. Going on down to the bottom here, this is where you'll see more of a numeric breakdown in the first section. And this is going to talk about some of the basic items, but again, it's important to make sure this matches up with your expectations. Now, in the upper section, you saw a sales price of $500,000. In this example, we're using a 10% down payment. So this gives us a loan amount of $450,000. The interest rate is listed very clearly, and this will show you your monthly payment. Now, keep in mind, this is just showing you the principal and interest payment. And if you're escrowing your taxes and insurance, this number will look different because that will include those costs, which is obviously a much higher figure. What I love about this document is that on the right-hand side, you'll see very clear directions on some of the changes that can't happen. Keep in mind, when you buy a home, you are going to sign a note. That note is your agreement as far as repaying the terms on this loan. And you want to make sure that those terms are fixed. So in this case, you'll see, can your loan amount go up? No. Your interest rate change? No. Will your payment change? As far as the principal and interest? No. Now, of course, that would not include taxes and insurance because we all know taxes like to go up. Below this, prepayment penalty, no balloon payment. So this is very important. This answers some of the most common questions that I receive from my clients when we're talking about are there prepayment penalties or if there's any type of hidden costs or anything that might come up. So this is a great section to watch for. Now below, this section tends to get more confusing. This is one of the parts of the closing disclosure that we will explain more often than not. So you'll see at the top, you're going to see your total monthly payment. Now in this is showing you what you should expect to pay. You'll see here we have your principal and interest, your mortgage insurance, and your estimated escrow amount. Again, if you're escrowing on this, which in this example we are setting up an escrow, which includes the taxes and insurance with the monthly payment, you're going to see all these items together make up the total monthly payment. So you want to make sure that this payment matches your expectations and what you're looking at. That goes on to show you the first expected payment for 10 years, and it'll give you an estimated payment over the remainder of the term. In this case, showing that the mortgage insurance would come off after 10 years just as a basic estimate, and then of course that payment goes down. Now, where it gets confusing is below this factor, you'll see the estimated taxes, insurance, and assessments. So when you're looking at this line, this is where people will get confused because they'll often combine these two payments and say, okay, $37.88 plus $12.26, wait a minute, that's way too high. That's not the way this breakdown is presented. The upper factor is showing you your total monthly payment. This section is showing you the separate portion outside of your principal and interest. So going through this will show you how much your taxes are, your HOA dues, and homeowners insurance, and just showing, and then more importantly on the right-hand side, in escrow. Right? And this is important to note. Are you escrowing your taxes and insurance? You don't want to be caught at the closing table with an escrow account if that wasn't your original intention. So pay close attention to this section. Now towards the bottom of the first page, we're going to have the closing costs and the cash to close. Again, sometimes this will get confusing because clients will look at this section and think that the closing costs is separate from the cash to close. The cash to close, the bottom line, is the remainder of money that you will need for the transaction minus any credits that you received. And this could include your earnest money or seller closing cost credits, any of those line items. So that will show you the remainder due based off what's been provided so far. However, the closing cost is showing you all the settlement fees that go into purchasing the home. And this will include your lender's fees, also any deposits for escrow accounts and other costs for the transaction. So it's not one plus the other, it's that the closing costs are going to be included in this bottom line. Now on the second page, we're going to see a more detailed breakdown of what those closing costs are. I mean, that was a pretty big number, right? There's over $22,000 in costs. Let's take a look and see where that number comes from. Looking forward here on the top section, under A, and these would be broken down alphabetically, you'll see A, B, C, but under A, these are your origination charge. This is an important section because this is going to show you what one lender may be charging when comparing to a different lender. This is going to show you their lender's fees, any type of application fees, anything that they're going to charge you as far as their services, underwriting, processing, funding, any of the things that go into supplying that financing and closing that transaction for you should be listed here. You also will look carefully because this is where you'll see if there's any type of points. Now, paying points to get a lower interest rate can actually be great in a high interest rate environment, and this can fit for the right scenario. But just make sure that when you're looking at this section that it's the agreed upon amount. Going through and looking at what a lender tells you they're going to charge, make sure that's in line, and this is where you'll see that listed. Now on the closing disclosure here, you're going to see at the top toolbar at closing and before closing. Well, before closing is referencing any of the items you may have paid up till that point. In this example, there's an application fee of $150 that was collected. That was paid prior to closing, and then at the closing, you're going to have a remaining amount due of $1,290 for the lender's fees. So this is showing in this example, no points. There's no fees other than the lender's fees that are listed here, totaling $1,440, and this gives you that breakdown. Below this, you're going to see a section that says services the borrower did not shop for under section B. And this is where you'll find third-party fees that are associated with your loan. And in this case, these providers were selected by your lender. So you'll see your appraisal fee, you're going to see your credit, tax service. Basically, these are the costs such as obtaining your credit report and getting the home appraised. Now, in this example, the appraisal cost was paid outside of closing prior to the closing date. So you'll see a $535 fee. However, it looks like in this example, the appraisal costs were less. So you'll actually see a credit here. You'll see a negative symbol next to this $50. So this, in fact, shows that the appraisal cost, if you subtract 50 from 535, was $485. You want to make sure this is in line with what you were expecting to pay. You'll hear me say that a lot, but it's important. And then going on, this was the cost of the credit. This can get confusing in Section C. So services borrower did shop for. Now this is where you're going to find, well, the majority of the cost. And these are the title charges, and this come from the title or escrow company. And what can be confusing is that it says services that the borrower shopped for, when you might be looking at this saying like, wait a minute, I didn't shop for my title. This was provided for me. Well, in the majority of the states, the seller is responsible for providing a clear and transferable title, and they're going to be the ones who select the title company. Now, these documents they're federally mandated, so these documents have to apply across all markets. And because there are in some markets where the buyer will select the title company, that's why this is falling under Section C. In the state of Illinois, where this example is prepared, then in that state, the seller provides a title. So in this case, the borrower did not shop for that. But going on, this is where you'll find a lot of costs broken down. Now, most lenders up front will give you a flat rate and tell you, you should pay $3,600, $3,700, $3,800 in title charges depending on the transaction. And you'll see that reflected in the top number. And this will go on through and tell you, what are these charges for? Back when I started in this industry, we used to call these junk fees, right? Because they add up quickly, and some of them start to feel a little bit ridiculous. I mean, I have to point out, we have an electronic document fee of $50. These are costs that go to facilitate the transaction for the title company. They can vary from one title company to the next, and although some of them can seem outrageous, I have to agree with that, but at the same time, they are necessary evils, if you will, for a transaction. So it's good to have an understanding of that. Now, if you're in a state where you use an attorney, then the attorney is going to break this down, and they're going to also look to make sure that there's nothing listed in these title fees that would be non-warranted, something that you really shouldn't be paying. I mean, you'll see right down at the bottom, we have a wire fee of $80. I don't know if you've sent a wire before, but it usually doesn't cost that much. Title update fees above that for updating any changes to the title. And then you're going to go on to see other factors. Basically, these are the costs that the title company estimates for providing their services, for providing you a clear and transferable title, making sure that there are no judgments and liens on the title. You want to make sure that you don't have what's called a cloudy title. Cloudy title means that there can be something that would create an issue, because keep in mind that when you purchase a property and you take ownership of everything that comes along with that property. So you want to make sure there's no money that could be owed to anyone. That's where title insurance comes in. If there was any liens that were not present when you closed on the property that come up at a later date, well, the title company will insure above that and say, okay, well, we didn't see that charge. There was nothing listed there. This is our responsibility. We'll either clear this or make sure that that's not your responsibility to pay. So it's important, but it's expensive. Another one that's common that people will question will be the lender's title insurance. So lender's title insurance is going to be it's the title company providing a search to make sure there are no other liens, no other mortgage liens that could take precedence over your initial loan. When you take a first mortgage, lenders want to be in that first lien position. Well, that's determined by the date that lien is recorded. So if there's an old lien on the title, that would be a problem for your new lender. So it's required by your lender, but this is provided by the title company. When you go through and you add up these services, this is where you're going to see what we call the total loan cost at the bottom. So you'll see $5,941. This is not $22,000. So where are the other costs coming from? Well, that brings us to the next section, other costs. Going through here, Section E, these are going to be fees that are going to be collected by the title or escrow company, but they're not payable to that company directly. For example, recording fees. Your mortgage must be recorded with the county, so you'll be charged for that service. And this is an estimate of what those charges are, and they charge per page. Also, in some cities and states or counties, you're going to pay a tax. These are called transfer tax or transfer stamps. This was set up in Chicago, so in this case, Chicago charges $7.50 for every $1,000 of your purchase price. That means we have, in this example, a $500,000 purchase price. So we multiply 500 by $7.50, and that's where we get that $3,750. And it's a large number. I often will refer to this almost like sales tax, because it's a cost that you pay at the closing that you won't have to pay anything else until later in the transaction. Something to point out, when we were looking at this, you'll see at the top borrower paid closing costs, and then to the right you'll see seller paid costs. Believe it or not, even though you're paying a lot of fees and title charges, and you're paying a lot of fees as far as the going through and looking at the transfer stamps, you'll see over in the other column the seller has their cost to pay as well. Keep that in mind for when you sell your property in the future. You will have some closing costs that will come back. Now, the next section under line F, these are prepaid items. Prepaid items are, well, they're costs that you're paying in advance. These are not fees that are being charged by the lender, but more so costs that go to third-party providers or for parts of the transaction that are due that you must pay in advance. In this case, when you purchase a home, you have to purchase an insurance policy for 1 year in advance. So we show 1 year's worth of insurance paid to the insurance company. Also prepaid will be the amount of interest remaining in the month. So it's important to point out here that when you pay interest on a loan, you're paying in arrears. That means when you pay on the first of the month, you're paying for the month that just passed. And you'll generally then skip over that following month before you start your payments. In this example, you'll see that we were looking at paying interest from the 3rd of July up through the 1st of August. In that example, we would be closing in July. You then would pay the interest due for the remainder of July. You would skip the month of August, and you would start your payments September 1st. And moving forward, you would make your payments on the 1st of the month, which would pay for the month that just passed. So September would actually pay for the month of August in this example. So to make sure that you're paying for the interest due for that first portion of the month that you live there, this is prepaid in advance. And that's where you'll see this interest. And this can add up. Some people like to try to close at the end of the month so that they can bring this number down and pay less at the closing table. But it's important to note, from the day you take possession of a property all the way up until it's paid off, if you're taking a 30-year fixed loan, you're paying 30 years, not short or added on even one single day. So even though it feels like you're paying less money because it's less due at the closing, that interest is still due. I always like to point that out. Now, we have an escrow account set up on this transaction, so this is where we'll go through and we'll find a property tax deposit. So based on when the tax bill is due, in this situation, the taxes we have to make sure that there's enough in this escrow account to pay the tax bill. Keep in mind, closed in July, going through and looking at this, then it looks like the first monthly payment would have been September 1st. Well, in this example, we need to make sure that there is enough in that escrow account to pay that tax bill. Because again, when you take ownership of that property, well, that's your tax bill now. You're responsible for that. And when you have an escrow account, especially, banks want to make sure those taxes are paid. So we have to make sure there's enough in that account to pay that tax bill. So this is a deposit that you're paying in advance to pay that tax bill in advance. Below this now, you'll see initial escrow payments at closing. This can get confusing because when you're looking at this, you're like, wait, I just paid insurance up here, I'm paying taxes, and now you have me paying more insurance and more taxes. So an escrow account is required to have a balance, or a cushion, if you will, of how much you have in that account at all times. This is going to be 2 months worth of the amount due. So skipping down to the property taxes, you'll see you have your monthly amount for 2 months. This $1,655 is required to be in that account at all time, and this will adjust as your taxes go up or down. There's an escrow analysis that will be run every year, so the service provider, whoever's holding your loan, will look at that and say, okay, we need to make sure if the taxes have gone up that we increase this figure. And if the taxes go down, they're going to send you a refund. It's federally regulated. They cannot hold more than 2 months at a time. Well, looking at this on your insurance, you're going to see here $34.17 for 3 months. Why is it 3 months and not 2 months? The way your insurance policy works, it's always your policy is always paid for a year in advance. So when you reach that 1 year anniversary, more importantly, 1 month before your 1 year anniversary of your closing date, your escrow account will then disperse payment for another 12 months for your homeowner's insurance. So that money is actually being sent out early. So in this example going through, we need 3 months because the payment goes out 1 month early, and the remainder is that 2-month cushion that you'll find afterwards. I know it feels like you're double paying your insurance, right? Because you paid a year in advance at the closing table, and then you pay monthly into that escrow account. It's like you're paying double. But what you're doing is you're just building that balance so that you have enough to pay that insurance for another year following thereafter. Under Section H, this is where you'll find other fees that you could look to pay in the future. In this case, in Illinois, we use attorneys. So this client hired an attorney. They paid $500 to that attorney. It's a great deal, actually. And they went through and they paid the attorney those funds. So this is where we show those other fees. If you had any other agreements to pay real estate commissions or any other type of representation in this is the section where you would find those costs. So make sure to pay attention. Well, we have a much different number here now. We have $17,161.46. Going back up at the top, our total loan costs were just under $6,000, right? So you can see that the majority of the costs come from these third-party providers when you're buying a home. So it's important to make sure that you're familiar with who these providers are and what those services are. But when you add the cost of the loan together with the other costs, such as the title charges and taxes, this is where we get that number of $22,852.46, which is going to look very familiar because that's the total of the closing costs we saw on the first page. It's where this number comes from. So again, this is a detailed, itemized breakdown, line by line, of where that number came from. Now, below this section, we're going to start to get into credits, right? You've paid enough. You've been, at this point in time, you've just been writing a check, one check after the next. Not that anyone really writes checks anymore, but going through and looking at this, now we'll start to look at some credits on your behalf. In this example, we had a lender credit of $250. So we start to subtract these credits from those closing costs. So you'll see here there's a $250 credit that is listed that will go and come off of those fees. Going on to the next page. This is one of my favorite pages because it really does bring everything into light as far as what the costs are like and what the credits are like. And what I'm going to do is I'm going to first skip down a section to the summaries of transactions because I want to give you a breakdown of this, and then we'll go back up to the top and we'll talk more about what you would have seen on the loan estimate versus your closing disclosure. And again, we're looking at a closing disclosure here, which is the final document before closing. So within this transaction, you're buying a $500,000 home, but really it's costing you $522,492.62, and that's because of the price of the property plus all these costs. This section will give you a breakdown of exactly how we arrive at these numbers and what's due. Line item 1 shows the price of the property. Line number 2 is going to show those closing costs that you have paid at closing. Going down now, we'll see some adjustments that for items that may be paid in advance. Now, in this case, this is a condo, and there are assessments that are due at the closing. So we're going to see this charge of $325. This is an additional cost that is coming into play here that increases those costs due at closing. Below this section, under line L, this is where we get into credits, or items that are already paid on behalf of the borrower at closing. So in this section, this is where you'll find your earnest money deposit. You'll see here in this case, we had a $21,000 deposit in earnest money. So that's going to be subtracted from that total amount due. Well, your loan amount is also a credit. So you'll see here we have a $450,000 loan amount. That's now subtracted from that total due. Remember, we owe over $522,000. Well, not once we include the loan amount, your earnest money deposit, and then any other credits. Now, this is where we see here the seller was giving a $2,000 credit. So keep in mind as you're looking through a closing disclosure, if you're expecting any credits from the seller for closing costs, or if there was anything for line items on an inspection maybe, this is where you'll find those credits. You want to make sure that everything lists exactly to what you were expecting. On the bottom here, now this is where we show deposits for your taxes. And this is important because in Illinois, the tax bill is paid in arrears, just like your mortgage interest. So that means that the tax bill you pay basically for that first year of ownership is going to be for the previous year. Well, you did not own that property. So in this example, the seller is going to give you a tax credit to make sure that when those taxes are paid, you're not the one responsible for paying that bill. So they'll give in an estimate on a prorated amount on what that will do, or as far as how much they're going to pay. And you're going to see those credits listed here. You'll see 2022 tax credit. You're going to see taxes for the first year. And these will show you those items. So it's important because, I mean, you're looking at a bunch of credits that will add up that will actually reduce the amount due at closing. $483,472.74 to be exact in credits. So if you owe $522,492 and you're receiving $483,472 in credits, that's how we arrive at that cash to close. That's why I love this section, is because this is going through and showing you exactly how you arrived at that other number we see on the first page, right? If you remember, we had the total closing costs and we had the cash to close. So this gives you a very good look at why you owe what you owe at closing. Why are you sending this money? Why did you wire $39,000 or write a check for that amount? This will give you a great breakdown on what to expect. Over at the top of that same section, you'll see the seller's transaction. Now I want to go to the back to the top of the page to talk about the section that says calculating cash to close. This is where you'll look to see what the differences are between that loan estimate and your closing disclosure. And you're going to see that these numbers are different. So in this example, the loan estimate showed just under $20,000 due, yet you got to the closing table and you needed almost $23,000. Well, this is where we get more into the details of what may have changed from the initial estimates versus the actual costs. Going back to the beginning of this video, that's where you're going to find things such as the title charges. You know, in this example, perhaps a lower amount was listed as far as the estimated title charges. Maybe going through the homeowner's insurance was listed at a different amount. So you're going to see those figures. This also will show on the final side here the costs that you paid before closing. So this is going through and showing appraisal costs and the application fee that we saw earlier. This is also going to show the down payment from the client, and you'll see that the earnest money is subtracted from that. You've already given that on your behalf. So at the bottom of this, when we're looking at this, you're going to notice one big difference is that in this example on the loan estimate, there was no deposit listed, right? So that's a big difference. Well, the loan estimate was issued before you knew which property you were purchasing or had agreed upon those terms. So we didn't know what that deposit was, right? We didn't know that there was a $2,000 seller credit. So that's why you'll see these differences between your loan estimate and your final closing disclosure. Now, it's important to note, although your title charges can change, your homeowner's insurance can change, yes, there can be credits from the seller, earnest money. Overall, your lender's fees should not change whatsoever. So if you're looking at these documents and that's changed, that's where you have a problem, and that's what you want to look out for. Unless, of course, there was a change during the transaction where maybe you decided you wanted to buy down the interest rate, so you agreed to pay points. Just always make sure the costs are in line. I mean, after all, that's the point of this document. Moving on to the third page of the closing disclosure, this is where you'll find some of the details that were listed in the beginning, but again, they're just going to be listed again here so that you can see that there's no prepayment penalties. You'll also understand how the late payments work on your loan and some other factors. So let's dive in and look at the third page. Right at the top, this is a very popular topic lately, is talking about assumption of mortgages. This is where you can see if this loan is assumable. In this case, it's a conventional loan, so it is not. Demand feature showing that there's no requirement of the money paid for that loan, so you shouldn't have to have early payment on your loan. This also will go through and show your late payment charges, which is standard. If you're more than 15 days late on your mortgage, you pay 5% of your mortgage payment as a late fee, and you'll see that listed here. Negative amortization means that your loan payment is not enough to pay down the balance owed, so your loan balance would actually go up. That's not a loan practice that we really see much of anymore, and in this case, you'll see that you do not have any type of negative am features on this. Partial payments. In this example, this is saying that the lender does not accept any partial payments. Now, keep in mind, after the loan servicing is set up, if you look to set up biweekly payments, paying every 2 weeks, which is, again, considered a form of partial payment, then you'll want to make arrangements for that. But at the time of closing, that was not allowed. And we'll go on and see the property address, or well, you can't see the property address, but this is where it was listed. And on the right-hand side, this is the escrow account information showing that you are setting up an escrow account. Again, this will be repeated throughout the documents, but it's important to make sure that if you're planning to escrow, that is reflected here. And if you were not planning on having an escrow account, then obviously that should match up with that figures. And this will go on and give you another breakdown of the cost of that escrow account, or the amount of the deposits that you expect to pay, and what that will do for your monthly payments. Going on then to the fourth page, this is going to walk through the calculations that are due on your loan. So this is a big number. You bought a $500,000 property, but when you add on all the interest, you'll see the total of those payments came up over $1 million. So this is where you'll see the total interest plus the purchase price on your property. And if you want a more detailed breakdown, look at the finance charge below that. So you'll see that it's expensive to buy a home. I mean, the good news is this is reflecting the total over 30 years. So chances are that property is worth a lot more than what you paid for it. Amount financed is going to show you the total of your loan amount after the costs, and then this is what impacts your APR. A lot of times people will look to shop their interest rate based on their annual percentage rate, which shows the cost of your credit, basically the closing cost plus your interest rate, and that's where you'll see this figure listed here. Again, that needs to stay in line. Now, there were some changes where technically your APR cannot vary by more than an eighth from the initial loan estimate. So if during the transaction something changes and your APR was to go up, say the lender fees increased, again, for maybe you're looking to buy down the interest rate, then a new loan estimate will have had to have been issued. Otherwise, that would be a hard stop. So generally, your APR should be right in line with what you've been expected. And then we'll go back through and show the total amount of interest that you'll pay over the loan term as a percentage again. I find APR and this TIP, the total interest percentage, it can be interesting if you're really into math and numbers, but most people don't think in percentages. So that's why it's always a good idea to look at your actual interest rate. Again, APR is not your actual interest rate. So you want to look at your actual interest rate, your actual monthly payment, and look at the actual dollar breakdown. I think that's more easy to identify. At the bottom, contact information for the lender that's involved. This is where you'll find contact information for other parties, your real estate broker, settlement agent, or the title company. You'll find all that information. And then we'll go through and confirm receipt of this documentation. So it's a lot. I know this video was long, but that's also why this video was so important. When you're going through and you're buying a home, there's a lot of costs associated outside of your down payment. The more prepared and the better understanding you have of what those closing costs are, the better chance you have of shopping for the deal that's right for you. It's important to understand that difference between, or the balance, I should say, between your closing costs and your interest rate. So I wanted to make sure that you have a good understanding. This way, when you see a loan estimate in the future, or when you're looking at your closing disclosures, you know exactly what to expect. And more importantly, you know what to look out for so that you know that you're not going to be taken advantage of. Hopefully you like this video. Remember to like, subscribe, and look for more updates as we share more videos with you about buying and real estate and other investment practices.